Yeah.
Here we go. Welcome. You're listening to Mortgage Investing 101, the show where we discuss high-yield real estate mortgage-backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co-host, Mark Hahn, president of Pacific Private Money, one of the fastest-growing private mortgage investment firms in Northern California. Our goal on this show is to provide information and to increase your awareness of these important alternative investment strategies where you can earn, get ready for this, secured high yields using your savings or IRA accounts. And get this again, annual yields of 8% or more are not uncommon.
That's right, we're not kidding.
Yeah. In fact, you're going to hear today how the last distribution was actually higher than that. But we like to be conservative and say annual yields of 8% or more are not uncommon using these strategies we're going to discuss in today's show. And if you like what you hear today, please call Pacific Private Money at 415-883-2150 for more information, or go to pacificprivatemoney.com. And our hotline number is 888-529-1134. You can leave your name and your question, and we'll get back to you after the show. For fun, we're also going to have trivia contests where before commercial breaks, we're going to be before commercial breaks, where we're going to ask the first three callers with the correct answer the question, and they're going to, I messed that one up. Okay. We're going to be answering trivia questions here on the show. And if you're one of the first three callers with the correct answer, you're going to win a free 3-day, 2-night stay at a vacation place. And that vacation place is not sponsored by the radio station, but by Lighthouse Resort and Marina, which is located 1 hour northeast of San Francisco. And the vacations are free. Lighthouse is only requesting a $75 house cleaning fee. Check them out at lighthouseforfun.com. Now, today's trivia theme is An American Christmas, since I just don't want it to end. Christmas was a few days ago, and I just got to hang on.
All right, well, we'll muddle through it.
Okay. So, Mark, the name of the show is called Mortgage Investing 101, and I'm going to turn it over to you now.
So, Edward, we started this show back in August of last year, and the reason we did is we have a sister show that's been running now for 3.5 years called The Best of Investing. It's a 1-hour show every Saturday at 1 p.m. on the other Clear Channel station, AM 910. We're, of course, broadcasting on AM 960, KNEW, this show. And so one of the reasons why we decided to do a second show and a first one on mortgage investing specifically is that I've been talking on the other show for the last 3.5 years about how people can earn 8% or more using their money on mortgage investment products, which we have discovered, over time, that just how few people really understand that this option is even available, and those who haven't heard about it really don't understand how it works. And so, generally speaking, in a marketplace, you equate higher yields with higher risk, right?
I mean, that's the norm.
That's the normal. And so when I talk to some people who are unfamiliar with mortgage investing, and we'll get into what mortgage investing is in a moment, when they're unfamiliar with that and they hear you can make 8% or more, they just assume that it must be risky. I mean,
in today's market,
in today's marketplace, where CDs are paying, 0.5 to 1 to 2%,
almost negative,
where bonds are paying very little, where the stock market yields, while the stock market is doing good now, if you look back over the last 10 years, it's only recently passed its inflation-adjusted high from 2004. So we're really in a marketplace where savings rates have been low for some time. Yields on traditional investments have been unreliable at best.
Yep.
And then you start hearing where, wow, you can make 8% or more year in, year out secured returns. And the answer is yes. And so we decided to start this show, Mortgage Investing 101, to really go through the basics of what is mortgage investing. So let's answer the question.
Okay.
We call the show Mortgage Investing. What is mortgage investing? Well, it actually goes by several names. You may have heard it called trust deed investing. A trust deed, of course, is a mortgage that is recorded in California. In California, we call mortgages deeds of trust. It's the same thing. For all intents and purposes, a deed of trust is a mortgage in California. So these are investments that are backed by mortgages or deeds of trust. It's also called private lending because you are the bank when you invest your funds in a mortgage-backed investment. It's also called mortgage pool investing. At Pacific Private Money, we have a mortgage pool fund that we'll talk about a little bit later in the show. And that mortgage pool fund is used for making loans secured by real estate. So essentially, your money is in a loan that is backed by real estate. It is virtually identical to the types of loans that the banks make.
Well, here's the funny thing is that when I put my money in a bank CD, the bank is taking the money and lending it out to various borrowers.
Right, you're exactly right. So,
Yeah.
so whether you know it or not, you've actually participated in
Yeah.
lending, in private lending, because if you put your private capital into a bank, that's exactly what they do.
Now the difference, though, and the audience will bring this up, is that when I put my money in a bank CD, it's FDIC insured.
That's true.
Now, but I'm only getting 0.5% or 1%. So the first question is, are the mortgages in the fund? I mean, is it FDIC insured?
No, it's
No.
not.
Okay.
It is not.
But
Now,
what is it backed by?
right, it's backed by real estate at conservative loan to value.
And that's the key.
That's-
Conservative loan to value.
That's the key. So, like banks, we at Pacific Private Money originate loans secured by real estate. We'll get into the types of loans that we make in a moment, but we essentially make loans just like the banks do. We make them the same way the banks do. We have a promissory note. We have a deed of trust that gets recorded. We have loan disclosures to the borrower. We actually have a fairly significant loan package that is anywhere from 60 to 80 pages long that the borrower signs. Again, very much like a bank loan. What's different than a bank loan is that we don't make 80% or 90% or 97%, which some banks do if it's FHA backed. We generally go no higher than 70% loan to value or loan to purchase price, since most of the loans we're making are to real estate investors who are buying income property.
Okay, so for a $300,000 purchase price of property, you're going to lend at most
At most 210,000 typically. Yes, that's exactly
Okay,
right.
which means that the borrower is going to have to come up with the $90,000, which is real skin in the game.
Right.
And by the way, audience, you're listening to Mortgage Investing 101 with Edward Brown and Mark Hahn of Pacific Private Money. And Mark can be reached at 415-883-2150 for more information about investing in mortgages via the mortgage fund he has that's currently paying how much?
The last quarter, third quarter distribution was at an 8.9% annual rate, and the weighted average loan to value at the time was just under 60% loan to value. So very well secured investments we were making with that mortgage pool fund capital.
Okay, so you were actually paying higher than the 8% that we talked about in the beginning of the show, and it's been more conservative than the 70% LTV.
That's exactly right. And so one of the things that is noteworthy is that again, like banks, we talked about how our products are virtually identical to bank loans. We fund through escrow companies. There's a lender's title policy obtained that provides title insurance to the lender, which is our mortgage pool fund. There's insurance, hazard insurance, that the borrower is required to obtain, and the mortgage pool fund is named as a additional insured, or a mortgagee as it's called in the business. So again, we have the same types of safety and security features in our loans that we make as the bank as do the banks. So really there's no difference in the type of collateral, the type of security, other than we lend more conservatively.
Okay, so
than the banks
let's go through this example. So the example I gave, Mr. Borrower is going to buy some piece of rental property for just to make that number simple, $300,000. You'll lend him $210,000, which is 70%. He comes in with $90,000. What's the risk now to you?
Well,
I mean, what
the
could
risk
happen?
is
What could
very
go wrong?
low, and what's indicative of that risk is we've made over 600 privately funded loans since 2008, when we founded Pacific Private Money, and virtually just a small handful of those loans have actually had to be foreclosed on, and in
Okay.
each of those cases, which were less than 10, no principal was lost by the lender. The lender actually, in every case, made more money than they had anticipated.
Why?
Well, because the real estate was worth more money
Okay.
than the loan that they
Or in
foreclosed.
some cases, if the loan didn't actually get completely foreclosed on, and the borrower was able to save it,
Right.
then
We've had to file notice of default for non-payment issues, but the borrower has always what they call cured the default, which means they found a way to basically make it current. And so in those cases, we would get late fees, and sometimes even a default interest rate would be charged, so that there was actually a profit made on that, on the fact that the borrower had some delayed payments, right?
Okay. Yeah, how much is that default rate, by the way?
The default rate is under 2%.
No, I'm sorry. The default rate.
Oh, the default rate of interest.
Rate, yeah,
So
4% higher
well,
than the note rate.
that goes to talk about the discussion of what kind of loans do you make. So first off, another difference of our loans compared to a bank loan is a bank loan might be 4.5% or 5%. Well, the loans we make, because we're making them to real estate investors and they're short-term loans, are oftentimes at a note rate on or about 10%.
10%.
And
okay.
so if they default, we have a default clause written in there where the rate automatically gets bumped up 4 percentage points.
So instead of 10, it's 14%.
That's exactly right. So we're incentivizing performance. We
Yeah.
do not want to make loans to a real estate investor who maybe, let's just say he wants to buy, fix, and flip a property, and he thinks he's going to do it in 4 or 5 months, which is not unusual. We make a lot of very short-term loans like that. And let's just say they promise to make monthly interest payments, but they decide, we're not going to make payments during the time that we're going to remodel and flip this property. And that's actually happened with us. We've had some borrowers who basically said, you know what, I know I'm going to flip this property really quick, and yeah, I know I'm supposed to make monthly payments, but I'm just going to, fix this property up and sell it, and I'll make all the interest payments on the back end when I sell the property and pay off the loan. Well, I'm not real fond of people telling me after the fact that they'd rather not make payments, so we will go ahead and okay, well that's fine, but it's not going to be at 10%. We're going to charge you the full 14% default rate and late fees, because that's what you bargained for. That's what the contract states. So again, we have a way of profiting from non-compliant borrowers. So again. And we've done that many times, and so again, our borrowers, our shareholders in the fund, they benefit, they profit from our knowledge and expertise in this marketplace where we are making loans to real estate investors who can't get money from banks, and we're profiting from that, and we're able to charge a higher rate of return. And they're happy to pay that because they can't get the financing elsewhere.
Well, we're going to get to that pretty soon here.
Good.
I thought it was really interesting is, in theory, you would really not want, you'd really want the borrower to not make payments and then make one very large payment at the end because of all the default interest and late fees. I mean, you make a nice little killing, and it's almost like if I put money in a CD, I'm not touching that money for 6 months or a year anyway.
That's right.
That's very interesting. Okay, we're going to cut to our first commercial break here. Again, you're listening to Edward Brown and Mark Hanf of Pacific Private Money. The name of the show is called Mortgage Investing 101. You can call Mark at 415-883-2150 for more information. Let's go to the first commercial break. First trivia question. Again, the theme is An American Christmas. What character plays the innkeeper in A Charlie Brown Christmas? The first 3 callers, I get to see the eyeballs going up on that one. The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. What character plays the innkeeper in A Charlie Brown Christmas? One more time, 888-529-1134. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. And when we come back, we're going to answer a couple of emails we received on Mortgage Investing 101. Stay tuned.
That's a good setup. So that was Lisa's tone when she called. I forgot to put my phone on vibrate. So she had to go back and re-meet the appraiser at Marin Oaks, the property we're buying in Ignacio to flip, because he showed up without his MLS key to get in the house. Turkey. It's like one of my investors came with me, and so we're both out there cooling our. First, he was 20 minutes late, and then he shows up without his key. It's like, really? So Lisa had to go back and meet him again.
Okay, so today's the right? That's our show.
Hmm?
That's our show, the 28th, yeah.
Yeah.
God, if I could do it over again, I would have just done no land, no development, no construction. Of course, we wouldn't have had as much business, but stand up. Can't live in the past, right?
So,
Ready?
to tell you about my, spent 2 hours in the office yesterday on my Sunday meeting with an applicant for an $8.3 million construction loan. I'll chat with you a little bit about
Okay.
either, if not today, then maybe, over the course of hanging out later in the week.
8.3 million.
Yeah.
Hold on.
There's a story behind it, and it's a good story. It could be a deal. Could be a loan.
Who's got the money now?
Well, I may have to broker it to one of the other CMA guys if they like it. I have to
Yeah,
sell
no,
it.
I'm not talking about it. Okay, here we go. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. When we cut to the first commercial break, we asked this trivia question. Again, the theme is An American Christmas. What character plays the innkeeper in A Charlie Brown Christmas?
Well, I don't remember his name, but I remember didn't he talk like this? Wah, 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 wah.
No, I think they all talk like that.
Didn't they? All the adults talk like that.
No, it wasn't an adult. Pigpen.
Oh, okay.
Yeah,
I
how
misunderstood the
appropriate, right? The
question.
dusty guy goes ahead and he's
That's
the
right. He
innkeeper.
played
Love
the
that.
innkeeper during the play.
There's the play. Yes.
That's right. Okay. Threw
Okay.
me there for a minute.
So, all right. Now, where should we start off? You go right to this email here.
Let's do email time.
Email
that sounds
time.
good.
Okay. Email we received. Dear Mortgage Investing 101, I've heard that funds are risky. Why is yours different? That puts you on the hot seat, huh?
Yes, indeed. So I get that question a lot, and a little background. Mortgage pool funds have been around for decades, and we started Pacific Private Money in 2008 because we saw that the marketplace had changed dramatically with respect to financing to real estate investors, remodelers, contractors, developers, basically that second segment of the market that is not the consumer home lending market, which is really the primary lending market in America today, is to consumers buying a home to live in. The other market segment, which is still it's smaller than the consumer home loan market, but it's still a fairly significant market, is real estate investors, whether they're contractors or just owner builders or what have you, who are investing in real estate. Now, before 2008, banks were making those loans. Banks were making consumer home loans, and banks were making loans to real estate investors who were investing in real estate and flipping properties, etc. Come the mortgage meltdown in 2007 and the financial meltdown in 2008, the banks pulled out of that market. They really stopped making investment type loans.
Okay.
Why is that important, and how does that relate to a mortgage pool fund? Well, very simple. Prior to 2008, mortgage pool funds, the type of loans they were making, the quality, if you want to call it, of loans that they were making were different than the loans we're making today. For example, most mortgage pool fund lenders were making seconds prior to 2008 because that was where the demand was for private capital, because they can go to a bank for a first,
sure.
but if you needed a second, oftentimes you would go, if you needed a second and you didn't qualify for a home equity loan, which many people could get back then, right?
Sure.
You would go to your hard money lender or your private lender and you would ask him for a second, and many hard money lenders were using mortgage pool funds to make those loans. So the types of loans they were making were different. They were mostly seconds, or they were development or land loans, which, again, banks were making those loans, but there were an awful lot of transactions that were occurring in the early to mid 2000s before, the whole real estate correction happened, that were, of the type and nature that a bank couldn't make that loan fast enough and and so they would go to a private money lender. So the mix of loan products that mortgage pool funds were making prior to 2008 was just a completely different animal, and they were riskier loans. Today, and for the last 5 years, the types of loans that we're now making, in fact, we make very few seconds today. Almost all of our loans are first position, mostly purchase loans that we make to allow someone to purchase money, and we're not making construction or development loans. We're just making simply 70% of the purchase price to real estate investors who are already capitalized with the remainder monies.
Well, you've got the benefit of doing first mortgages because the banks aren't lending.
That's absolutely right. So we have this new marketplace that didn't exist 10 years ago. And so a fund 10 years ago was making riskier loans, and they were making lots of seconds. And so when the market turned, a lot of those mortgage pool funds found out that in 2008, after prices went down dramatically in many markets, they found that a lot of those loans they made were now underwater. So they, like many banks who were making these firsts and seconds to provide 100% financing to consumers, who found themselves underwater, these mortgage pool funds found themselves having a lot of non-performing loans. So people who invested in mortgage pool funds prior to 2008, and who oftentimes were enjoying 10, 11, 12% yields. I mean, the yields that these mortgage pool funds back then were paying were in the double digits. So it was riskier. It was a different product. It was a different marketplace. It was definitely a different era. So we've got now, years later, it's 2013, for the past 5 years, we've had a new industry supplied of making loans to real estate investors. First position, the capital has come from the same place that it's always come from. It's coming from private individuals who are investing a portion of their retirement savings into the mortgage pool fund to fund these loans.
And let me try to make an analogy here, if I understand this correctly. Most people are familiar with mutual funds, which are basically investing in, let's say, stocks. Make it simple. Would you consider your fund to be like a mutual fund but of mortgages?
It's like a mutual fund of mortgages. One of the differences that is that on a mutual fund, in theory, it's highly liquid because it's traded publicly, and you could buy in one day and sell the next. In our mortgage pool fund, we ask people to make a commitment of a minimum of 2 years. So we have a commitment of 2 years in which, should you need to redeem your money earlier than that, you can. There is a small redemption fee. After 24 months, there is no redemption fee whatsoever. So that is when it does become similar to a mutual fund, in that 100% of your money gets put to use. There's no loads or no fees. No load and no fee to the investor, to the shareholder who makes an investment in our mortgage pool fund. And that, quite frankly, I believe most mortgage pool funds are set up that way. Nor is there a redemption fee after 24 months.
Well,
so
you said that there's a small redemption fee in the first 24 months.
There is a small redemption fee. So it's scaled so that the first 6 months it's 5%, then the next 6 months it's 4, then 3, then 2. So if you had to get your money out, let's say in month 19, so you were in the last 6 months of the redemption period, we would charge you 2% to redeem your money.
But if you are paying what you've been paying, let's say it stays at 8.9%, let's say you compound it,
let's just say it's 8 for 2 years consecutively.
Okay, all right.
You get a 16%. Well, it'd be a little bit less because theirs wasn't in for a full 2 years. It was in for a year and a half. So you get 8% for the first year, then 4%. So they made 12% on their money. We're going to charge a 2% redemption fee for, quote, early withdrawal. Their net return for that 18 months is still 10%.
Pretty good. Not bad.
Not bad. So you don't lose all yours, which I know the penalty for early withdrawal in some government sponsored and or bank sponsored
all the interest.
It's fairly considerable. It's almost like
Okay, so you got something here where you're paying right now over 8%. It's theoretically tied up for 2 years. You can get out with a small penalty. After 2 years, you can get out with no penalty, and there's no fees to get in.
Right, no fees to get in, no fees to get out after 2 years. all of your money works for you as a shareholder. We have security of collateral by having a recorded deed of trust on every loan. We have security of what we call protective equity because we lend at conservative loans to value, no higher than 70%, and more often less than that. And we've got the protection of insurance in case the collateral burns down. The monies first go to the lender. So we have insurance, we have security. So we do oftentimes say secured and insured, but it's not FDIC insured. So if you're looking for FDIC insurance, which that's another conversation, but I'm not 100% convinced that that's the be-all end-all either.
And not when you're earning 0.5% on your money.
Right, exactly. So there is we started talking about last segment a little bit of risk reward. I think the inherent risks to a mortgage pool fund are far outweighed by the incredible returns that we pay. And let's face it, most people I know need to have the type of yields that we're able to generate through our mortgage pool fund.
Okay, now I'm still not quite convinced. All right, a question is, why would Mr. Borrower pay you 10% interest? I'm trying to still wrap my arms around.
Right, it's got to be a lousy borrower. I mean, who in God's green earth would pay 10% for money, right?
10%?
I've got some of the strongest borrowers that I have ever seen.
Known to man.
Unbelievable. I mean, these guys have great credit. Not every borrower that I make a loan to has stellar credit.
Okay.
But I'm making loans to guys with 700 and 800 FICO scores because their bank can't make a loan as fast as I can. And in this market today,
Steve.
If you read the paper and you understand how the real estate market is working today, the all cash buyers are getting all the best deals.
That's true. I have heard that. So if a guy comes in and says, I want money tomorrow, can you give him that money that fast?
Generally not in one day, but
Okay.
we can in as few as 3 days, and oftentimes in 5. More often than not, it's 7 to 10 business days. But what ends up happening is how they can compete with an all-cash buyer is they can go in and make the same offer or a more aggressive offer and have no contingencies whatsoever. Say, we'll close in 11 days or 14 days. So it's like an all-cash offer, but they're using a no contingency, hard money loan. And for my repeat borrower clients, I'm able to give them a letter that basically says that we intend to close on this loan with no contingencies, et cetera. And that for our borrowers is a fabulous tool for them to allow them to buy some of these great deals that are still out there, by the way, regardless of what you read in the papers about foreclosures being done, they're not.
I'm thinking, okay, if you're making a loan, let's say in 3 days, it better not be a place in Iowa that you're not familiar with.
We're lending almost exclusively in Northern California. Now, we're California lenders who can do Southern California, and we do some from time to time, but 90% of our deal flow is in Northern California, more specifically in the Bay Area. That's where, that's the area that we know. I've personally been involved in Bay Area real estate since 1982. So for over 30 years, I've got experience mostly as a principal working for a real estate development company. So when I started this company in 2008, it was actually for 2 reasons. Number one, there wasn't a whole lot of new development going on in it, but number 2, I saw the opportunity in the marketplace and took advantage of it. And fortunately, my crystal ball was right on that one because the demand for capital, the demand for private capital today is stronger than ever. We have got at Pacific Private Money some of the strongest loan applications you will ever see. Now, I did say earlier that some of our borrowers do have damaged credit, but it's damaged because they're real estate investors. They bought property in 2005 and 6 like everyone else was doing who was a real estate investor back then, and some of them lost those properties to foreclosure or did a strategic foreclosure, meaning they walked away because, hey, they bought the property and it went down 50% or more in value. And
well, in theory, that could happen again, couldn't it?
Well, it could, but look, we've had a huge market correction, anywhere from 30 to 50% in markets throughout the Bay Area. What would have to happen to see something like that again? I mean, clearly we're not in a bubble now. I don't think anybody who knows anything about how the economy works today can argue with a straight face that we're staring down yet another real estate bubble. It's just
No,
not there.
there may be a correction because it's gone up for a little bit.
Well,
but
let's say there's a correction. Let's say it's looking ahead to 2014, if mortgage rates spiked, what would that do to affect real estate prices? Well,
probably bring it down.
it could have. Let's say they went down 10%, which I think would be surprising to see a 10% drop in real estate prices. Let's just say there's a 10% drop. We're not making 80 or 90% loans. We're making 70% loans.
Okay, so the
Oftentimes
borrower's
it's
still
65 or
got equity in
60%.
there.
The borrower still got equity. The borrower has incentive. And let's not forget, the market correction didn't happen overnight. It took several years
That's true.
for prices to go down 30 to 50%. It's not going to go down 10% overnight either.
Yeah, and your loans are not 15-year loans.
They're
to these
not
borrowers.
they're not 5-year loans. They're usually 6 to 12 month loans.
Before we go to another commercial break here, how do people get a hold of you?
So there's several ways to get a hold of us. One is to go to the radio show website, which is mortgageinvesting101.com. On that site is our contact information as well as podcasts from previous shows. So if you're just tuning in and you're thinking, oh my gosh, this sounds great, I wish I'd heard it from the beginning, just go to our podcast page of previous podcasts, and there the last 20 podcasts are available for you. But if you also just if you're able to write this down, if you're not driving, don't get distracted for the moment. But our phone number is 415-883-2150. That's the number for Pacific Private Money. We're based in Marin County. 415-883-2150. You can leave your name and number, and we'll get back to you, and we'll shoot you by email more information on how you can earn 8% or more using your savings or self-directed IRA accounts through mortgage investing.
Okay, we're going to cut to our second commercial break here, and again, the theme is An American Christmas. What is the largest selling Christmas song of all time? The first three callers with the correct, I see the eyeballs go up again. What is the first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. What is the largest selling Christmas song of all time? One more time, 888-529-1134. Make sure to include your name and your email address. Speak slowly, spell out your email one letter at a time. Don't touch that dial. Mortgage Investing 101 will be right back, and Mark's going to explain the deal of the week.
Had to say that, didn't you?
Yeah, of course.
Deal of the week. I'm going to go run to the
Boiler
restroom.
room.
Yes. Slipping that water. Refill.
Yeah. Last
All right,
week,
deal of the week. What the heck were you talking about?
last week, I can't remember what the question was. It was kind of a hard question. I got 12 emails on our first trivia question. It was a hard one. I don't remember what it was, but I've written down some. Okay. Oh yeah, let me see how much time we got here.
Maybe I'll talk about, again, I know how I'll answer it.
Okay.
So,
We got 15.
Gutierrez, do you remember what, she bought it for 300 and you did a 70%. I'll just use 300. I think it was like 305 or 310 or 305.
315.
Was it 315?
Well, wait, it was 70%.
Yeah.
I'll tell you.
That's right, you're long.
Yeah, I got it right here, yeah. So let's go right here. Terrace. Was that that wasn't Napa? That was the first one we did.
Napa.
Oh, it was Napa. Yeah,
Yeah.
that's right. 'Cause we did 70, 270. 385.
Yeah, I think that's right.
Yeah.
There was a great price.
Yeah, because I remember seeing even on Zillow things were selling for over 400,000.
Yeah. So 270 or 385.
Okay, ready? 15 minutes. Away we go. Well, welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hoff, president of Pacific Private Money. When we come to the second commercial break, we ask this trivia question. Again, the theme is An American Christmas. What is the largest selling Christmas song of all time?
I'm going to guess Jingle Bells.
No,
No.
White Christmas.
Oh.
I'm dreaming of a white Christmas.
Oh, that's right.
Okay.
Okay.
Now, we promised the audience, kept them in suspenders there over the commercial break. Give us the deal of the week. I mean, give us an exact example of something either you worked on or something you closed.
Okay. Well, I could give a rather boring example of kind of a cookie cutter buy, fix, and flip loan scenario, of which the majority of the loans we make are just that. It's a guy who found an opportunity, and oftentimes in today's market right now, it's more often than not, it's a short sale. They may have been in contract for several months. It's a short sale, meaning the seller is selling the property for less than what's owed on it. Those still take a long time to get approved by the banks because the banks have to agree to accept a lesser payout than what they're owed. And so that seems to be the most common example that we're doing. And they're all over the Bay Area. If I had to pick maybe one area, the East Bay seems to be where we see more and more opportunities. There's still a lot of people underwater with homes, actually all over the Bay Area, and all over California, and all over the United States. There's still, in fact, I don't know, Edward, if you knew this, there's still 2 million homes in California.
Just in California?
That are considered underwater. And to be considered underwater, we're actually including in that 2 million figure homes that are just maybe above what's owed on them, but functionally speaking, they can't sell the house because there's not enough money to pay the commissions,
but now the
closing
borrower's
costs.
still paying the mortgage.
Right. Yeah. Not all of those
no.
2 million
Okay.
underwater homes are in default.
Okay.
I'm just saying that as a market, there's still an awful lot of opportunities for real estate investors to buy a home via short sale. And why would you want to buy a home as a real estate investor via short sale? The reason is because almost 100% of the time you're getting a short sale discount. It's not the same for every property, and there isn't a typical discount other than to say 5 to 10% below fair market value is not unusual. And again, for a real estate investor who's solving for making as much profit as he can, he wants to buy the house at a good price. He's going to improve it. He's going to put it back on the market and make a small profit. There's
been a lot of houses purchased in 2004, 5, and 6.
There
to
were
produce 2 million of these.
unbelievable amount of transactions were happening. So
give us exactly.
So I'm going to give you an example that's not an example of someone who's buying, fixing, and flipping. I'm going to give you an example of another type of loan that we are able to do in the marketplace today that the banks can't do. In fact, by definition, the banks aren't able to do it, and it's called a consumer bridge loan. And what a consumer bridge loan is let's say you're looking to buy a home, you're living in your home now, you own your home today, you're living in it, you intend to sell it, maybe it's on the market right now. You found the home you want to buy, and then you go into contract to buy it thinking that, well, I'll get a bank loan and buy that home and then sell my other home. Well, guess what?
The bank doesn't want you to own two homes,
The
right?
banks do not, more often than not, you don't qualify.
Yeah.
The typical person doesn't qualify for two home loans in today's underwriting.
But now that homeowner, that borrower of yours, they're still coming up with 30%. They must have had some cash.
They are.
Okay.
So how does that involve us? Well, we can make a short-term bridge loan, bridging the gap between the time they want to buy this target property they're looking at and the time at which they'd be able to pay off that loan by selling their existing home. So that's called a bridge loan. So we did one that closed, I think it closed 2 weeks ago actually, and it was in Napa. And so this family, in fact, the person who was the applicant, they didn't want to put their home on the market until they knew that they had a place to live. They did not want to go through the trouble of having to move twice. They didn't want to like move into an apartment or put their stuff in storage. So instead, they decided to take advantage of the bridge loan opportunity to borrow money privately, or you could also call it a hard money loan because that's in fact what it is. And we made them a loan to help them buy this wonderful newer property in Napa, and the purchase price was $385,000. They were actually getting a really good deal. It was also a short sale. The target property that they were buying was a short sale from the seller, so they got it for $385,000. We did our own valuation, and we believe the property was, probably could have fetched $400,000.
Even I did see that property. It was a beautiful piece of property, and in fact, even Zillow, which sometimes is accurate, sometimes it's not. Even they said it was worth $415,000, I believe.
Yeah, so we made a loan to allow this person to be able to buy the home, and we made him a 70% loan, 70% of the $385,000 purchase price. The loan amount was $270,000. They had sufficient capital to come in with the closing costs, and they're going to pay it off by getting a conventional bank loan, which they'll qualify for once they sell the existing home, which they're now moving out of to move into their new home, so that they can stage and sell for the highest possible price their previous home.
And is there any issue with them being able to make the mortgage payment?
In this case, no. And in most cases, no. Again, people in this situation generally they've got 1 to 2 incomes, they've got cash in the bank, they've got good credit. They just didn't qualify to own 2 homes simultaneously. So they were able to use a hard money loan. Now, was it expensive for the consumer to do
what
this?
did it cost?
Well, it was. I mean, although we sharpened our pencils a little bit, we made a loan to them for, I believe the note rate was just under 10%. I think it was in the 9s. We would typically charge 3 points for a loan, but on this one we charged 2 because the broker in the deal was a friend of mine and asked me for a favor, and I did it. So 2 points. It was still, in terms of fees, the buyer had to come, between with closing with hard money processing and our points, they still paid, I think, close to $7,500 for that money, but they got the home of their dreams.
And they got it at a discount. So explain about how the points work. Is that how you make your money? I mean, do you take all the points?
So the points, here's what's interesting, and how our mortgage pool fund is really designed to profit in today's marketplace, via hard money loans. 50%, half of the origination points we charge to a borrower get put into the fund in addition to 100% of the interest charged on the note rate. So our mortgage pool fund is designed to profit from short-term loans, because if we take the money in the fund and we can loan it out 2 times in a year versus one time a year, or making a long-term loan, for example, with the origination fees, with 50% of the origination fees going into the fund to the benefit of the shareholders, that actually helps boost the yield even higher. So again, it's a benefit. Now, what's a point? A point is equal to 1%. So if it's a $500,000 loan, 1 point is $5,000. If it's 2 points, that'd be $10,000. So we charge that, and most private money and hard money lenders who charge points, that's how they, the broker, earn their living.
Yeah, I haven't heard of funds where the broker is splitting the points with the fund. Usually they take it all for
It
themselves.
is unusual. It's not typical. But again, we decided we wanted to design the fund to succeed in the Northern California lending market. And in the Northern California lending market, we oftentimes need to make loans that are a little bit less than elsewhere in other markets in the United States. There are mortgage pool funds in other states that are offering yields, that are making loans at 12, 14, 15%, because that's the market in there. But in the Bay Area, and again, I love Bay Area real estate. I know Bay Area real estate. I'm comfortable with Bay Area real estate, and I believe that most of our shareholders in the Pacific Private Money Fund also have a comfort level with being involved in an investment where we're lending on Bay Area real estate.
Well, sure, because if anything goes wrong with the property, if it's, let's say, in Cleveland, Ohio, now what are you going to do?
What do you do then?
Yeah.
Right, the cost to cure, the cost to fly out there with a team, it adds expenses which take away from the performance of the fund. So again, we know, our fund performs very, very well in this market because we understand it. And also keep in mind, understanding the Bay Area real estate market also means we know where not to lend. So if I'm trying to lend in Cleveland, Ohio, there's probably neighborhoods of Cleveland, Ohio that nobody in their right mind would lend unless you didn't know any better. And so I have no business making a loan in Cleveland, Ohio when I don't understand the marketplace there. But I do understand the marketplace in the Bay Area, so that certain pockets of certain neighborhoods in certain Bay Area cities, we will not make a loan there. Not that it's a risky loan, it's just we don't feel comfortable, and I don't want to have to foreclose. Should I have to foreclose?
Well, yeah,
on
I guess you have to
areas?
assume that whenever you make a loan, what's the worst case scenario? You're going to have to foreclose and take over that property.
That's right. So that is actually what is another difference that we have in our in our mortgage pool fund and in our lending criteria that's different from the banks. Banks are not allowed by federal law to discriminate or redline, as they call it. You can't decide not to lend in this city versus that city. Well, private lenders aren't forced to live in that same type of universe. We can be discriminating in the types of loans we do. Now, that's not discriminatory. It just means that we don't have to play by the same rules. If we're not comfortable making a loan to a certain person or secured by a certain property, we can decline. And
Yeah,
so,
sometimes just looking in the whites of their eyes, you can sense an uncomfortable feeling. You don't want to make that loan.
well, and the reason for that is because I am a fiduciary for my shareholders who are lending their retirement savings, and so I have a higher order of responsibility to make sure that I'm not making a loan that is outside our underwriting criteria, and we have very strict underwriting
Yeah, because
criteria.
the
believe it or not.
taxpayers aren't going to bail you out.
That's exactly right. There's no taxpayer bailout. So, and I'm not getting my money from the Federal Reserve and borrowing it, at the overnight window from the feds at 0.1% like the banks do. So it's a completely different business and operating model.
Okay, so to kind of summarize here, you have a mortgage pool fund that is right now. What's the average yield and loan to value?
The average loan to value of the fund right now is right at 60%.
60%.
Yeah.
Okay, so 60% LTV for those sophisticated
It's
people
the
out there.
weighted average loan to value. If you take all of the loans in there and divide it by the market value of the total security, we've got 14 loans in the fund right now. It's 60%. We have 40% protected
And do you get
equity.
appraisals?
Absolutely. We get
Okay.
valuations on every deal that we do.
Okay.
Yeah.
Boy, you know, every time I ask you a question, you just come right back with a good answer there, my friend.
Hey, I do this stuff in my sleep.
Okay.
I better know the answer.
And what's the yield to the clients right now?
The yield to the clients as of the third quarter distribution was at an annualized rate of 8.9%. Now, keep in mind, too, one of the benefits of the fund are that if you don't want to take distributions, you can allow that money to accumulate and compound. So those who are not taking distributions for that period, it would be a little over 9% would be their effective yield.
Awesome. And again, for the audience listening out there, how do they get a hold of you? What's the name of the show?
And the show is Mortgage Investing 101. We have a website, mortgageinvesting101.com, or go to pacificprivatemoney.com. That's our corporate website for the broker, Pacific Private Money. So go to pacificprivatemoney.com for more information, or call us at 415-883-2150. That's 415-883-2150.
Once again, thank you, Mark Hahn, for joining me in the studio
You're
here.
very welcome, Edward.
Okay. Tune in next week to Mortgage Investing 101. We're going to be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing. Again, if you go to Mortgage Investing 101, you can get a hold of us and leave an email or a phone message with a question. Thanks for listening. I'm your host, Edward Brown. And on behalf of Mortgage Investing 101, so long. We'll catch you next week.